It's 1993. The smartest rooms on Wall Street are packed with Ivy League MBAs, quantitative analysts running cutting-edge computer models, and hedge fund managers charging 2 and 20 to beat the market. They have more data, more technology, and more firepower than any investor in history. And somewhere in Omaha, Nebraska, a state that doesn't even have a major stock exchange, a 63-year-old man in a modest office is quietly turning every $10,000 invested with him in 1965 into more than $88 million. The stock market is a device for transferring money from the impatient to the patient. That man, of course, is Warren Buffett. And today we're asking the question Wall Street insiders hate: who actually wins in the long run? Buffett's old-school value investing philosophy, or the trillion-dollar machine of modern Wall Street? Stick around, because the answer might make you rethink everything you believe about investing. First, let's define our terms. When we say Wall Street, we don't just mean a street in Manhattan. We're talking about the entire ecosystem of active money management, hedge funds, mutual funds, investment banks, proprietary trading desks. These are institutions managing tens of trillions of dollars, employing hundreds of thousands of the world's brightest minds. Their core promise? That through superior analysis, timing, and strategy, they can beat the broader market and deliver returns above average for their clients. Now contrast that with Buffett's philosophy. Buy wonderful businesses at fair prices. Hold them, not for months, not for years, but sometimes forever. Don't try to predict the market. Don't trade in and out. Don't follow quarterly earnings calls like they're holy scripture. It sounds almost embarrassingly simple. Which is exactly why most Wall Street professionals have spent decades dismissing it. So who's right? Let's go to the scoreboard. Let's look at the raw data. Since 1965, Berkshire Hathaway, Buffett's holding company, has compounded at roughly 19.8% annually. The S&P 500, in the same period, compounded at about 10.2%. That gap sounds small. It is not. That's the magic of compounding. $1,000 invested in the S&P 500 in 1965 would be worth roughly $235,000 today. The same $1,000 in Berkshire? Over $36 million. Now let's look at Wall Street. According to Spiva, the S&P Indices versus Active Funds scorecard, over a 20-year period, more than 90% of actively managed large-cap funds underperform the S&P 500 index after fees. Over 20 years, more than 9 in 10 professional fund managers failed to beat a simple index fund. Not 50%. Not 60%. 90%. And those are the ones still in business. Many funds that underperform are quietly closed or merged, a phenomenon researchers call survivorship bias, skewing the record of remaining funds to look better than it actually is. So right out of the gate, Buffett isn't just beating Wall Street. He's in a different universe entirely. Here's where it gets interesting. Many Wall Street fund managers are actually smart, talented people. So why do they keep losing? There are 3 structural reasons Buffett himself has explained and exploited for decades. Number 1, fees. The classic hedge fund charges 2% annually on assets plus 20% of all profits. On $1 million portfolio, that's $20,000 a year before you've made a single dollar. Compounded over decades, fees alone can destroy 40 to 60% of your potential wealth. Buffett famously wagered $1 million that a simple S&P 500 index fund would beat a basket of hedge funds over 10 years. He won, handily. Number 2, short-termism. Fund managers are judged quarterly. If you underperform for 2 quarters in a row, investors pull money, you lose your job. This forces managers to chase short-term performance rather than make the long-horizon bets that actually build wealth. Buffett's genius is structural. He answers to no one on a quarterly basis. Number 3, complexity for complexity's sake. Wall Street sells sophistication. Options, derivatives, leverage strategies, quantitative algorithms, these products generate fees. They exist not because they produce better returns, but because complexity is harder to audit. As Buffett once said, never invest in a business you can't understand. Wall Street's incentive is the opposite. These aren't bugs. They're features of a system designed to extract wealth, not necessarily create it. In 2008, Warren Buffett made a $1 million public bet. He challenged any hedge fund manager to prove, over 10 years, that their actively managed funds could beat an S&P 500 index fund after fees. Only one firm took the bet, Protégé Partners, a respected fund of funds that selected 5 top hedge funds for the showdown. The results, revealed in 2017, Buffett's chosen Vanguard S&P 500 index fund returned 125.8% over the decade. The hedge fund average? 36.3%. That's not a close race. That's a demolition. Buffett's entire $1 million prize went to charity, because the real point was never the money. It was the message: stop paying high fees for underperformance dressed up in expensive suits. Wall Street's genius is packaging average returns in a way that feels like exceptional value. But here's the honest counterargument: Buffett was measuring during one of the greatest bull markets in history. The S&P 500 benefits from an upward tide. What about in downturns? In the spirit of fairness, let's steelman Wall Street's position, because not everything they do is smoke and mirrors. First, risk management. Many hedge funds don't aim to beat the S&P 500 in bull markets. They aim for uncorrelated returns that protect capital in crashes. In 2008, when the S&P fell 37%, many macro hedge funds posted positive returns. Berkshire Hathaway itself fell nearly 32% that year. Second, Buffett's edge may be diminishing. He's said himself that managing a $900 billion portfolio is fundamentally different from managing $10 million. Size kills alpha. The strategies that made him rich in the 1960s and 70s literally cannot be replicated at Berkshire's current scale. Third, access to alternatives. Ultra-high net worth investors can access private equity, venture capital, and real assets that genuinely diversify beyond what a retail investor can replicate. Some institutional strategies really do add value unavailable to the average person. The honest verdict? Wall Street isn't entirely wrong. But it is overwhelmingly overpriced for what it delivers to the average investor. The few strategies that work are not available to most people paying the fees. So who wins long term? On a pure returns basis, Buffett wins decisively. His compounding record across 60 years is one of the most statistically improbable achievements in financial history. But here's the real twist: Buffett's biggest lesson isn't about stock picking. In his most recent shareholder letters, he's told ordinary investors not to try to replicate his method. His actual advice for most people? Buy a low-cost S&P 500 index fund and hold it forever. That's it. Not individual stocks. Not hedge funds. A boring, cheap index fund. The man who beat Wall Street for 6 decades is telling you, don't play their game, and don't try to play his game either. Just own America's best companies at the lowest possible cost, and wait. That's the most subversive thing about Warren Buffett. His very existence proves Wall Street's model is broken, and his most powerful public advice is to ignore both Wall Street and individual stock picking in favor of the most boring strategy imaginable. The real loser isn't Wall Street. It's every ordinary investor who pays high fees and trades too much, thinking sophistication is the path to wealth. Complexity is Wall Street's product. Patience is Buffett's product. History has voted. So the next time someone in an expensive suit tells you they have a proprietary strategy to beat the market, remember Omaha. Remember the bet. Remember the 90% failure rate. The greatest investor in history thinks you should be boring with your money. And boring, compounding patiently over decades, is the most radical thing you can do in a world that profits from your impatience. If this video made you think differently about money, hit that like button. It genuinely helps this channel grow. Subscribe if you want more breakdowns like this every week. And drop in the comments, are you Team Buffett or do you still believe in active management? I read every reply. I'll see you in the next one.